we don't really know where the world is gonna go. But now everybody knows that you can't stop for too long. Got to keep.
The first step in generating wealth is to pay yourself first.
But now everybody knows.
Stay tuned.
Stay protected.
Stay focused.
Stay connected.
There's a lot of different types of HELOC products that are now on the market, some of them geared towards velocity banking, and that's really good news.
This is probably the largest asset you will ever have in your life.
Right.
Here's some direction and some instruction on how to leverage this vehicle so that you can help yourself, help your family, accomplish your goals. We're not educated that way.
We use a strategy to pay off our home in 4 years.
Validation of your retirement account says what you thought was a retirement account is no longer one.
When I tell you, you're going to be shocked to learn. If you didn't come from a wealthy family,
You can make sure a wealthy family comes from you. So it starts with pay yourself first. Today,
Yeah, starting today.
right now, put your money in somewhere secure. It's about the ability to not lose. I will take base hits all day long versus winning and losing. Somewhere secure, compound your money, and then you leverage OPM, other people's money, to exponentially grow it. That's how you generate wealth.
So whether you're joining us to crush debt or build wealth, time is the most valuable asset.
and we're so grateful that you're spending your time here with us.
Got to keep going.
Good evening. Tonight we are talking about a lawsuit that is going viral. This is pertaining to an IUL that was went in force in 2018, and in 2025 there was an aha moment that led the policy owner into the courtroom. This is against the carrier and the agent.
Yes.
And so what do you need to know about this? This case is going viral right now, and sometimes in some instances for all the wrong reasons. And so we're going to break this down. We've seen very few instances of people breaking this down in a fair manner and really talking about the facts of the case, at least the facts that we know now as we are going live. This case has only been out, or the information has only really been released and kind of hitting the streams, I guess, for about 5 days now.
Yeah, it's fairly new, and I think there are new developments by the hour. Here's the thing. I'm not here to litigate this case. That's not my job. I'm more concerned about the information that's being shared around the impact on IULs in general. This is pouring a stain on life insurance, specifically IULs in general. So I want to break down some of the reasons why. I want to break down how you specifically might be affected and how you can avoid this cautionary tale of Kyle Busch. Like, man, it sucks to be for what he went through and what his family's dealing with, but there's some things that you need to know about your policy and how things are happen within your policy to make sure you don't deal with the same.
The most important thing, though, is those who have a policy, regardless of what kind of policy it is, regardless of what community you belong to or what side of the industry you are involved in. I would say that's probably a better word, a better way of explaining it. Regardless of what side you're involved in, what's important to note is pay attention to the information. We have given you all access to all information. Of course, there's Google. You can Google this. Feel free. But we've also included the docket. We've included the information that was filed with the court. So we've got a QR code coming up, and you can download that and take a look for yourself of what was filed, and then compare it to what is being shared inside of whatever community you're involved in. That is probably the most important thing to take away from this. It's not just being aware of how to read an illustration, understanding how things are structured, all of the details that we're going to go over and why something like this could happen. It's more important that you see who is using this information right now to their benefit. That is probably the most red flag moment for me and the most alarming thing, and the reason why we felt like we had to get out here and talk about it.
Yeah, because normally this does not affect us specifically, right? But I think it's important. There's so much misinformation and there's such a misunderstanding around life insurance in general. And you know what we do here. We pull back the curtain, we peel back the layers so that we can understand the reasons why and what's actually being said. So I'm excited to share it. I'm a little irritated too, but we'll dig into all of that.
Yeah. So if you're on your wealth building journey and your goal is to make confident, educated decisions, and you're out here trying to educate yourself so that you can do so, then you're in the right place. So if you're new here, jump in the chat. And this is a great place to ask questions, share your comments, share your opinions or your thoughts. What's going through your mind? Were you even aware of this before we started talking about it? Because I don't think that it's on the majority of people's radar, but it is going viral. And so it's bound to show up if you're looking at various vehicles for retirement income. Specifically, that word we're going to dive in just a moment. I want to welcome everyone to the chat. Hello. Oh, we have some new names in the chat. Mr. 2020 Chicago. Hello. Welcome.
Hello.
Yeah, we got some fam in here too. Hey, Jay. All right, Gabo's in here, so we can get started officially.
The gang's all here.
Yeah, gang's all here. Well, not the whole gang. So jump in the chat if you're new and you're just tuning into us. We'd like to know where you're from, and we just like to know who's tuning in. So if you have questions, this is a great time while we're live to ask those questions. But if you're watching the replay, of course, you can just put them in the comments below, and we'll address them as soon as we see them. All right, you ready to get started?
Let's do it.
All right, let's go. Here we go.
The goal should be, where can I achieve exponential growth? Exponential growth.
Let's just get into it. Let's just get into it.
All right, you good?
Yes, we are. Yes,
All right.
we are. And can you hear me okay, correct? So we've been spending these last few weeks actually focused on self-directed retirement accounts, specifically IRAs and 401ks and the differences between the two. And today we were actually supposed to continue down that path and focus on how to fund your retirement account if you didn't have any money. This new development as it relates to this Busch lawsuit kind of prompted us to kind of pivot a little bit. I think that's the cool part about us going live as well, is we have the ability to shift when we need to, and we wanted to focus on another aspect of what it is we talk through. It's about leverage. It's about understanding where leverage is located. Once you understand how to use leverage, you realize it's everywhere. And so our objective is to put properly designed products in front of you so that you understand where your leverage is located to be able to generate wealth or income or do infinite banking or invest in non-traditional investments, whatever it is. So today we want to focus on life insurance. And I'll give you the end first. If you want to understand whether your policy is structured correctly to be able to do everything that we're going to discuss to properly achieve your goals, head over to selfdirected.info, jump on my calendar, and I'd be happy to review. I reviewed this year alone probably 150 policies. And I'll be honest with you, of those 150, maybe 2 were designed correctly. So what we're getting into today is not new, not unusual, but I want to make sure we break down, peel back the layers on it. So again, we're going to focus on life insurance today. And specifically, again, it's about leverage and understanding where your structure lives. Every deal lives and dies by its structure. Meaning it's all about the design of whatever it is you're investing in, whatever it is you're focused on. All deals live and die by the structure that they're designed with. And specifically, what structure allows for is it allows you to determine who controls this deal, meaning based off the structure of any of the opportunities that you're dealing with, it determines control. It also determines how cash flow moves throughout the product. It doesn't matter what we're talking about. It doesn't matter if we're talking about HELOCs or velocity banking or infinite banking, where and how the cash flow moves is a strong factor as to whether or not the structure of the leverage that you're focused on is working successfully, and how much risk you carry. How things are structured can determine whether or not what you're dealing with can put you in a position where you can end up back in debt, or you're paying high interest debt unknowingly, and how much return you keep. Again, structure determines all of these factors, and specifically, if we want to focus on income, how much income you can actually depend upon is strictly determined by structure. And this is not a new subject that we talk through on this channel, because a lot of my client base are, I'll call it, real estate entrepreneurs. There's a lot of you participating on this live or in this space in general who are in the real estate space. So if you are in real estate, you know that all deals are dependent upon the structure of those opportunities, meaning that structure determines ownership. What are the splits inside of this opportunity? What are those terms? What is that cash flow, and who's receiving it first? Who skims off the top? It determines ROI and risk. Again, would you get involved in a real estate opportunity if it wasn't structured effectively? Why? Because a bad structure in a real estate opportunity causes what? Lost revenue, lost control, loss in general. Well, guess what? Life insurance is no different. When we talk about policies and life insurance policies, whether index universal life insurance policies, whole life, variable life, universal life, it is all about the structure. The structure dictates what's happening. The structure determines, based off that design, how it's being funded and what accessibility you have to the liquidity in it. And it also determines what those compound cycles look like, how quickly your money is making money. And lastly, a poor structure or poor design of a policy leads to what? Lost performance. Leads to what? This situation that we're dealing with, or that Kyle Busch is dealing with, it ends up being, hey, I was sold something that I didn't get. I was told I was going to receive something. I was told that my policy was going to perform a certain way, and it's not. So bad structure causes lost performance, lost control, and ultimately lost dollars over time. So as it relates to life insurance in general, what does that structure need to look like? We covered this a few weeks ago, so this is a rehash of a slide that we've kind of shared in a past live. So I'm not going to go into the detail, but this is what the structure looks like. It is dependent upon the carrier, and the type of product you get from that carrier is important. And then ultimately, it's how it's designed. Who designs your policy? If you're getting the policy from life insurance company X, that design 9 times out of 10 didn't come from specifically life insurance company X. 9 times out of 10, it came from an agent. And how that agent is focused on that design and or structure determines how all of these pieces go together. So when you put all of this together and you put it together effectively, you have a pretty solid product. And so we want to spend some time covering or talking about this lawsuit that, again, is fairly new. I want to say it's about five days or so, and there's a lot of new developments coming about. But the moral of the story is this article that highlighted it says Kyle Busch lost somewhere around alleging that Kyle Busch has lost $8.5 million on the verge of losing $8.5 million inside of his policy. How? Why? What happened? Well, the details are slowly making their way out. And again, my objective is not to litigate what's going on with this court case, but I do want to highlight some areas. And depending on what you look at, depending on where you go, depending on what search engine you use, you may find different things. So I'm just going to highlight a few of the things that we know so far. And I love this part. It is truly subjective because we truly don't know. And what does that look like? Well, there's some information out there that says, hey, this gentleman and his family had about 4 IULs that went belly up. Is it 4? We don't know. There's likely around 75 to 100 million in death benefit, meaning across 2 policies, there's so much life insurance being purchased that it could have caused or impacted a part of this this implosion. And then about 10.9 million in cash premiums paid. Based off the court documents, I'm not seeing 10.9 million, but my point is there's a lot of information out there and it's subjective. And how about this? 12 times higher cost of insurance due to being a NASCAR driver. Here's what we know to be true. When it comes to life insurance, when it comes to a company insuring your life such that if something happens to you, your family's taken care of, your line of work matters. If your job was to jump off buildings for whatever the reason, how likely would you jumping off buildings compared to me, who my job is to sit in front of my laptop and have conversations with you every day? Who's at more risk as it relates to life insurance? Obviously, the person with the more risky line of work would be harder to insure, but 12 times higher cost of insurance? I don't know about that. But my point is, that's what we're seeing here. Policy design. Policy design that gave the agent who created it $1 million in commission. Now, I've seen 35% commission, and if I understand it correctly, Kyle was putting in $1 million a year for the first 5 years. 35% commission on $1 million is 350 grand, not necessarily $1 million. So I don't know. Again, not here to litigate. My point is there's a lot of information out there. And this information is quite scary. $1 million commission off a $5 million input, that's pretty significant. And go ahead. Well, didn't leave a dollar of commission on the table for the agent Rod Smith that we know is not necessarily true, but my point is there's information out there around him receiving $1 million in commission, and I've also seen 35%.
Yeah, I agree that it's all over the board.
It's just all over the board. It's everywhere. And policy designed to lose 90% of its value due to policy charges in the first 10 years. Again, I don't know the specifics, but I do agree with design. Meaning the structure of this policy is probably a large reason as to why it performs or lack of performance that it has. Credit rating being around 1.5%. We'll talk through credit rating and what that even means and how it impacts your policy. But this credit rating being 1.5% because there was a certain amount of cash value that was left in the fixed cash account. That again speaks to structure and design problems. And then 3 policies lapsed despite the $10.9 million in premiums. Moral of the story is there is a lot of information around this subject. The question that I have is what's true and what's false. And for those of you with cash value life insurance products, those of you thinking about getting a cash value life insurance product, how does this explanation, these details impact what it is you're trying to do? We will dig into.
Hold on, bring it. Where? No, this is what I wanted to do. Zoom in on that. No, just the top stories part. The top stories part.
Yep.
Because you gotta pay attention to this part. Just in a quick Google search, what comes up? It's contradictory information or claims.
Depending on which one
Right.
you're looking at.
They lost 10.4 million, lost 8.5 million.
Which is it? What's true? What's false?
There are a lot of articles out here, and the most unnerving part of this is Rosalind, by the way, is in the chat, and she's saying, "Thanks for doing this review. I saw this and got concerned." This is for you.
Absolutely.
This is the reason why we're doing this, because it is confusing. And when you're getting all of this, this contradicting positions on this information, it begs the question of why. Especially some of these articles are coming from like professional journalism sources, right? Like they're supposed to be forthright with facts.
Fiduciary.
Right. Well, they're supposed to. But then there's also these communities that we've seen and these posts that are coming out of these communities that are also leaving out a whole lot of information that's obviously available. Go ahead.
Well, and we'll definitely dig more into that. But, I do a lot of hovering. I hover in a lot of groups, a lot of IBC groups, a lot of whole life groups, because I want to see what people are saying. And there is almost a celebratory
Right.
feel in some of these groups, like, ha, 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 it's happening over there, not happening over here. Like, it's quite strange.
Yeah,
Quite strange.
and that's really concerning, because when you're leaving out information because you know that only this part of the information can benefit you, it's really unfortunate, because the truth is, which we're going to go over, it's everywhere.
It's everywhere.
But why are they leaving out information, and why are they covering it in this particular way? This isn't a this isn't a he got scammed in general, right? Because there's a lot of scams out there, not just within one particular industry.
Right.
The point of why we're peeling back these layers is because I love a good rabbit hole. So
And you love
there's
tea.
that. And I love what?
Tea.
Yes. And I love it when the tea is hot. And so that's why when I went to go look up information, I'm like, how are these people out here posting? If I can just lightly search Google and find the court, what was filed with the court.
Right.
If I can do that, then why are they not including this information, or why are they claiming like the Twitter X post that you just had up? There's information in there that is not anywhere else. So where would they have gotten that information, right? These are just speculations that people are making at this point, and some of them, where are they getting this information from? It doesn't matter. The point is, though, we are going to cover the information that we did have access to. And so we're not making up information, but there are some things that are missing out of this equation that obviously people are trying to fill in the gaps based off of what may benefit them. I don't think that's fair. We have seen a few very fair reviews with the information that matters and what you need to know or what you need to take away from this. So that's what we'll hold on to and hug tight to. Fair?
Yeah, absolutely. So specifically, you had mentioned there is some.
I'm trying to go back to this. Okay, there you go.
There's some information out there and I found this video from David McKnight. I thought he did a really good job.
He did.
Of kind of breaking down what claims are within the lawsuit. Not what I think happened, what might have happened. These were the pieces that were pulled out of the lawsuit. I thought he did a really good job. So normally we don't big up other creatives on this channel, but I thought he did a really good job, really good breakdown. I have a lot of respect for Mr. McKnight. I thought he did a really good breakdown of what's happening inside of the claim itself. And so specifically, their policies were supposed to switch from an increasing death benefit to a level death benefit after year 1. What does that even mean? And if you've been on this channel, you know we break down this a lot because how much life insurance you buy matters. And an increasing death benefit is saying, as I contribute into my policy's cash value is growing. I want the death benefit to increase as I contribute. That allows me to have maximum cash value. And then at some point, when I decide I want income, I want that increasing death benefit to shift to a level death benefit policy. But here's the thing, when it shifts matters. And this says after year 1, if I'm building this policy, it can't shift after year 1. At the point where this policy was purchased, I believe Kyle was 35 years of age. We want the policy growth to be the maximum amount as long as we possibly can, and then we'll shift to a level death benefit once it's time to start taking income. It's definitely not at year 1. They were told certain premium payments would be final and that the policy would be fully funded. Fully funded has its own term. I won't address that, but certain premium payments will be final. That tells me that based off the $1 million a year for the next 5 years, he wasn't supposed to put anything else in his policy, but he received an invoice saying, hey, we're missing a premium. And as a result, the policy started to implode. And then this one jumped out, and I hadn't seen this anywhere. And I appreciated it being here. And that is in the midst of funding his policy, meaning he started his policy at age 35, somewhere around year 3, year 4, he did a 1035 exchange inside the policy. What is a 1035 exchange? Well, a 1035 exchange is where you're going to bring cash value from another policy and bring that into your new policy to set up new structure. Well, what happens when you do that? The clock restarts, meaning you're starting a brand new policy starting from day 0. So in doing so, that means the fees change. That means the commission starts over. Like there's a lot of impact to doing this 1035 exchange in the midst of the policy. It would have made more sense to start a brand new policy under the guise of this 1035 exchange. Use the 1035 exchange to start a brand new policy, not bring it into this one. Moral of the story is, these are some pretty significant actions that could cause problems inside of a policy if you're expecting certain performance. And so I appreciated this being called out because this is absolutely fact-based, based off what's being shown in the lawsuit itself. And so when you dig into that article that I was referencing, there's a few pieces that stood out in the article. And again, these are not my words. These are quotes taken from Kyle himself. And I was like, wait a second, what am I getting? Why am I getting a 6-year premium payment? Again, from his perspective, hey, I put in $1 million a year for the next 5 years. And at year 6, I shouldn't be getting a premium payment. Why? Well, based off what I shared prior to this slide, it kind of speaks to, I think I understand why he got a premium payment. Why? Because the clock started over when he did a 1035 exchange. So he wasn't at year 5, he was actually at year maybe 2. So therefore, there was another premium due. And then independent firm found that the policy would expire in 16 months. That ultimately says to me, if he wasn't making a contribution, then the policy was in danger of lapsing because there was a contribution requiring to be paid. And then and this is the piece that really stuck with me, because I don't think he was wrong here. Hey, I'm putting $1 million a year in for the next 5 years. My expectation, again, he's 35. He started this policy when he was 35. Putting $1 million a year in for the next 5 years, that told me this is a 5-pay, meaning I'm putting in five large amounts over the next 5 years. And then by age 52, so from age 35 to age 52, after 18 years of growth, I'm expecting $800,000 a year in the potential of being able to take as income when I'm ready. Is that even possible? Well, I'm going to say I believe in a properly structured policy, this is possible. But when I have a lot of clients who want to do 3-pay, 5-pay, 7-pay, 9-pay policies, but here's what you have to remember. When you're putting money into a policy and you're building cash value, there are fees. There's a structure inside of your policy that there are fees associated with that. And so what you want is you want to make sure that you have enough going into the policy to compensate for any of that fee structure. So the piece missing to me, I'll make it smaller. You can leave me big. The piece missing to me was, if the goal is to put in 5 years of premium so that you can get this $800,000 a year at age 52, there needs to be some amount that's ongoing to compensate for the fee structure inside the policy. So maybe a different approach might be breaking down that $1 million and splitting up, making a portion of it a lump sum and making a portion of that 1 million an ongoing contribution that you can extend beyond the 5 years. My point is, I think this is important because this is a large reason why the policy was having the struggle that it was having. And again, our objective, our goal is not to litigate this on this channel. We want to highlight some of the issues and break down how you can prepare yourself or make sure that you aren't dealing with any of these same struggles. And if you want to know more about this case in general, scan this QR code. It will take you to the court documents. You can absolutely read it for yourself. Use it as something to put yourself to sleep at night if you would like, if you want to know more details. But here's what we did. We took this information we just shared with you, the article, some of the information coming from some of the videos and some of the details coming from the Google search, and we went to our other family member and asked their opinion. You guys know who our other family member is, right? And what we identified was, this is not an IUL problem. Although this may be framed in the IBC community and in the Nelson Nash Facebook groups, and it may be being framed as an IUL problem because this specifically happened to Kyle and it was an IUL that was the problem in his specific case. But this issue here is not an IUL problem. This is an industry problem. This is a life insurance industry problem. Why do I say that? Well, it's because the structure issues that I referenced isn't only specific to IULs. And I'm going to show you in comparison how an IUL and specifically a whole life policy can cause the same problem. So the issue is not an IUL issue. The issue is this industry. The issue is, do people creating these products fully understand what it is they're creating? And as a matter of fact, what makes us even different? What is it that we do that's different? I'm a licensed life insurance provider that my sole purpose and goal is to make sure these policies, whether it's an IUL, whole life, annuity, doesn't matter, structured properly. That's my objective. But as a retirement consultant, as someone who creates IRAs and 401ks, as someone who creates properly structured cash value life insurance products, the goal is to make sure that you have the ability to invest in what you want when you want. You about to say something?
Yeah, I was just going to bring up in regards to this being a industry problem,
Industry issue
that
yes.
we actually have a video out there. It's a blue thumbnail and it says life insurance something something. I'll put a link in the description below after we're done here. This video was started because we started to see this trend, especially on TikTok, that there was this trend of life insurance agents who were making content for other life insurance agents. You wouldn't think that your clients would see this content. All they were talking about was the amount of money that they were making in this industry. So then they were attracting a bunch of people who were also started making money. How are they making the money? Where's the money coming from? And are these the average tenure for a life insurance agent is somewhere around 1 year? Like 90% of agents don't make it past the first year, but those policies are supposed to make it past a year, right? Those policies are supposed to be good. The point that I'm trying to make, though, here is there is an industry-wide problem with the way that the companies are marketing this to people, to agents. There was one person in particular who had it told us that their goal was to be on the stage of said company because that was, an achievement that they wanted to have. That's great, but if it comes off of
At the expense
of other people, right? If the goal is more for you to be able to get some achievement, and the goal isn't how can I help as many people as possible gain access to income, gain access to leverage, gain access to building wealth, that's a problem. But they're incentivized, and these companies are incentivizing the agents to behave this way. And this is where it is so important what we're talking about and peeling these layers back. How could this happen? Because a lot of people are looking at their own policies going, well, could this possibly happen to me? Right. What is it that was different that was done for me? Or was anything done different? If I'm a client and I'm on the other side of this article and this scandal that's going viral, I want answers, and I want to be able to sleep at night, and I want to confidently know that in 5 years, this is not going to be me. Right. In 6 years or in 10 years or whatever it is. This is not going to be me. That's what I want to know. I want receipts. I want proof. I want to know. And so that is what we're going to talk about. That's what we're going to get further into. But the point is, this is not an IUL issue. Although it feels like there's like insurance religions out there or denominations of a religion. And there are people who are utilizing this for their own benefit to leave out information because it serves them in whatever initiative that they're trying to prove. And it's become very political in this way. That's not the case. So I hope that if you take anything away from that, it is to look at everything, including us, with a magnifying glass, and make sure that you can, with confidence, know that the information that is being shared with you is being shared through clarity, it is educational, right? And it leaves you feeling more confident in what it is that you're doing and that not trust me.
Right.
Trust me, trust us, because this is what we believe in.
The same way we arm you with the tools, we want to arm you also with the knowledge to be able to ask the right questions.
Yeah. And so in any industry, it's not just that the insurance industry is a problem. That's not the case, because there are good people. There are good products. There are good brokers. There are good firms within this industry that are holding up their fiduciary responsibility. In any industry, though, there are bad players, and there are players who will leverage for their own personal gain. And that's just unfortunate. But that is the landscape that we're looking at right now. And so we just keep that in mind.
About insurance being a predatory industry. And I think this is just another one of those examples where without the right structure and guardrails, this is what you get. And this is not a stain on IUL. This is a stain on the industry. This is a stain on all who call themselves fiduciaries. This is a stain on anyone who writes a policy, whether it's a Medicare or a life insurance or auto insurance. It's a stain on the industry. And we have to understand the whys so that we can know what not to do, or at least ask better questions.
Yeah. So for those who are just jumping in on this T, can you go to the thing before with the QR code?
Sure.
Okay. This is So important if you want all the tea on what happened here in this particular case so that you can understand the factors that led to what happened, right? Which is important. You need to understand like the history of this case, which is all right here. No, this way. Okay. It's all right here. It talks about how it started. What had happened was, right? It talks about the history of this agent and his relationship with other litigations and lawsuits that he's been involved in based off of the way that he was structuring things. And when I say he was structuring things, this is part of the problem is there's a freedom out here to structure things and do what you want. And so if you want to get creative, boy, you can get creative because that's the freedom that you have over here with XYZ carrier. And we don't have that freedom. We don't have that freedom. We have to do things in a particular way. And the reason why we have to do them that way is because we are contracted, or we cannot represent the product in general, right? Same thing with an IRA or 401k. We can't just decide what the rules are. And that's the problem, is there are some companies out here who are allowing people to just decide what the rules are, and which is wild because if you had there are people who put things in place for protection. We talked about that with the structure of an IRA and a 401k, and that some companies put so many bumpers and red tape up that it makes it very difficult to even use them. And all of those are added fees as well. It's really no different in the life insurance industry. And I think this is one where you do want to have those extra red tapes and bumpers, not necessarily fees, but it doesn't have to equate to fees, right? This
goes back to structure.
Yeah.
It all is rooted in the term, in the word structure, how it's built.
Yes. If you're on your phone, just screenshot it, and then you can press and hold on the QR code later. And that's a hack. If you didn't know, you could do that. But this right here has what had happened. It's got all the juice in there that you want to understand what this agent's relationship was with this client, what the company's relationship was with the agent and with the client, and how even they got involved and were incentivizing not just the agent, but also pressuring the client into the decisions. So somebody asked, like, why would they do a 1031 exchange? Well, it's in here. So again, we can't represent the case.
Right.
That's not what we're wanting to do.
Not the goal.
Right. We're just wanting to peel back the layers on how does something like this even happen, and because the majority of what you're going to hear is because it was an IUL, and that is just not true.
It's not.
Okay, here we go.
And so I kind of jumped the gun on our extra person in our family a little bit that gave us a little bit better assessment. But I wanted to highlight a comment from this article. So the original article that we had referenced here, this article, if you were to spend some time reading it, when you get to the bottom, there are comments from individuals who read it and wanted to leave their perspective. Well, one of the comments from this article in general highlighted the fact that, as we mentioned, this is not just an IUL problem. The comment says this. Let's see, where am I? There I am. Wow, that's the same thing that happened to me. I bought a whole life insurance policy, and after so many years, was told that it would be self-funding as well. Well, that was 1987, and I'm still paying the same premiums. Go figure. This is not an IUL issue. This is a structure issue. This is an industry issue. If you are working with an agent who does not understand why they are doing something or why something has to be structured a certain way, you need to ask better questions or find a better agent. Because the key piece here, the common theme is structure and design. If you don't understand the structure and you don't understand the design, you could be putting yourself in a position where you have a whole life policy that you thought was going to be self-funded, but ends up not. And that's 22 years ago. And so what we ended up doing, what was made very clear to us is there is a gap. There's a gap between what Kyle was sold and what actually happened inside his policy. And as we mentioned, we're not here to litigate what occurred, but it is clear, there's a huge gap between what happened, what he thought would happen and what actually happened. And I want to say this is a pretty large telling factor as to the impact of why his policy is performing different than he thought. Now, why a 1031 exchange was done? Again, I get this question often because usually people have these policies from other agencies, other life insurance companies that have some cash value and they want to move that cash value into this new structure that I'm creating. Well, the way you move that cash value penalty-free, tax-free is by doing a 1031 exchange. So there are reasons why, or there are reasons where this may make sense. And again, I don't know his particular situation, but clearly it was done. But if you're going to do a 1031 exchange, here's not the point. You want to do it at the start. You want to do that 1031 exchange here because then the impact on the policy or the growth on the policy or the structure of the policy isn't compromised. That was not done. So I believe that's a large reason as to why. So what we ended up doing was taking all of this information and simply dumping it into ChatGPT. Taking the article, taking the snippets of the videos, taking some of the details of the comments that we found online, and just wanted to understand why. What happened to Kyle's policy and what caused it to fail? And I thought this was a pretty decent list.
Yeah, or what it thought.
Right, what it thought. Again, ChatGPT is not the Bible, at least it's not yet. But based off the criteria that was submitted into it, what was the details that could be pulled from why this policy might have failed? And I thought these were some pretty, I'll call it decent reasons as to why that I wanted to kind of break down. So if these were some of the reasons that may have caused it, what I want to make sure that we all understand is what these mean and how your policy might be impacted by the same. So the first one being, this was sold as a tax-free retirement plan. What does that mean? Sold as a tax-free retirement plan. Well, to understand what that means, we need to kind of dig into some information. And it first starts with, you have a policy or you're thinking about getting a policy. What is the purpose? What is the point? What is the goal of that policy? And from Kyle's perspective, his goal was, hey, I'm going to put $5 million in over the next 5 years. And by 52, I should be able to take $800,000 a year in income. His goal is income. If your goal is income, is your policy currently structured to be able to achieve that goal? And so with that being the goal, with his goal being tax-free income, and what another important piece here is it's tax-free income at what point? His goal was prior to retirement age. Any IRA, 401k, 403b, TSP, government 457 plan you get, if you're 35 years of age and your objective is tax-free or income in general, when can you take that income? You have to wait till you're told. Whether that's 59 and a half, 65, 67, when you get enough points, whatever that is. He was looking to be able to take income from a properly designed cash value life insurance policy at whatever age he chose. And in his case, it was age 52. Is that even possible? Yes, it's possible. But to understand income, we have to understand retirement accounts versus cash value life insurance policies. There is a difference between the two. And I will zoom in on this, but I just wanted to highlight there are differences between what a retirement account can do and what a cash value life insurance policy can do and the reasons why you have them. And I want to highlight one key piece, access to funds. If the goal is income.
Yeah, I was going to say, go ahead and I'll just take you off.
Okay. If the goal is income, meaning I want access to my funds when I want access to my funds. And again, this is the retirement column. This is the retirement account column that includes what? IRAs, 401ks, 403bs, you name it. These are your qualified accounts, solo 401ks, Roth IRAs, etc. In order to have access to your funds, you have to meet the criteria of being 59 and a half. That is when you can start taking, whether it's taxable or tax-free distributions without penalty. So you have to wait till you're a certain age. Well, if I wanted the same access to my funds in a cash value life insurance policy, what does that look like? Well, to have access to your cash value life insurance or the liquidity in your cash value life insurance policy, in order to have access, how do you take though be able to use those funds. Can you withdraw from a cash value life insurance policy? You absolutely can. But if you were to withdraw from a cash value life insurance policy, you may find yourself impacted by some tax associated with anything above your basis. So if you're working with the right agent, they will tell you that anytime you want to access your cash value, you want to borrow against it. You don't want to withdraw from it, you want to borrow against it. So ultimately what's happening here is this is a cash value life insurance policy that does not produce retirement income. It builds cash value that allows you to borrow against or take policy loans that can be accessed tax-free, and that can be used for whatever you want, to include income. So actual retirement accounts produce retirement income. Cash value life insurance policies can supplement that. It's an and asset. And what you hear on this channel all the time is, it's not, should I only do a self-directed 401k or an IRA, or should I only do cash value life insurance policies, or should I only do velocity banking? No, these are and assets, meaning you should have a properly designed cash value life insurance policy. Why? It allows you to have access to your cash value, liquidity at any point in time, regardless of age, and you should have a properly structured retirement account that once you do hit that 59 and a half or whatever that retirement age is, you have that vehicle that can produce income as well. And so when we talk about income, let's be clear, because again, this was sold as a retirement plan. How do you get income? How do you get that tax-free income if the policy was sold as a retirement plan? How does that happen? Well, again, first off, from a retirement account perspective, again, traditional IRA, 401k, Roth IRA, 401k, which ones produce qualified retirement income? Only qualified accounts produce qualified income. So traditional IRAs, 401ks can do it. Roth IRAs and 401ks can do it. But cash value life insurance policies, they are not qualified plans. Some people think annuities are qualified plans. They're actually not. They're life insurance-based products that can hold qualified plans, meaning you can have an annuity that you transfer traditional or Roth dollars into it, and then what happens with the annuity is it takes on the form of whatever money you put in it, which means, can you get taxable income out of annuity? Well, if you fund the annuity with a traditional IRA or 401k, then that annuity is going to produce taxable income. If you contribute Roth 401k or Roth IRA dollars into an annuity, then that annuity is going to produce tax-free income. So it takes on the form based off the dollars you put in it. But as it relates to cash value life insurance policies specifically, life insurance policies function under a different IRS code, 7702. They are not qualified plans. You cannot achieve qualified retirement income from them. But you can achieve supplemental or have access to tax-free income in the form of policy loans. When you borrow against your cash value, that borrowed dollar amount you get to take as income, and that income that you take is not taxable. Why? Because borrowed dollars, you don't owe taxes on dollars that you borrow. Borrowed dollars do not have a tax rate associated with them. So with cash value life insurance policies, can you take tax-free income? Yes. It's just not qualified retirement income because it's not a qualified account. This can be quite confusing. And it's confusing because words matter. The words you use in this process can have a significant difference on the impact as to what it is you're able to receive. So if you run into a life insurance agent, and that life insurance agent says, hey, yeah, you can get tax-free income out of this product. All you have to do is withdraw your cash value to be able to use it for whatever you want. If you hear the word cash value life insurance policy and the word withdraw, you should run, because you never want to withdraw from a cash value life insurance policy because it may incur a taxable event. Can you borrow against your policy? Borrow against the policy in the form of an index or policy loan and use that dollar amount for whatever you want? Absolutely. So how do you get the income out? As it relates to cash value life insurance policies, it's about borrowing against the cash value. And as I mentioned, words have impact. Words matter. So when we talk about borrowing, notice I said borrow against your policy. I didn't say borrow from your policy. Those are two different things. So when you borrow, you're taking a loan against your cash value. And why is that? Or what is the impact of doing so? The impact of doing so means the policy stays intact. If I'm borrowing against my cash value, let me use round numbers. Let's say you got $100,000 of cash value and you want to borrow $10,000 to go buy your son a used vehicle so he can get back and forth to school. Can you borrow that $10,000 from the $100,000 you have? Yes. When you borrow that $10,000, the $100,000 that's sitting in the policy doesn't move. It's still performing under the guise or whatever the structure is inside of that policy. And when you borrow that $10,000, you're borrowing it in the fashion of a tax-free dollar amount. There's no tax owed on that $10,000. Whereas if this was a qualified account, like a 401k, like an IRA, and you were taking distributions from that 401k and IRA, it is a withdrawal, which means using the same scenario, if you've got $100,000 in a 401k and you're wanting to withdraw 10,000, take 10,000 in income from that 401k, you are withdrawing 10,000 from that 100,000, which means there's 90 left, which means you are permanently removing a dollar amount from that, from the basis in which you had. So a withdrawn amount reduces your cash value if it's related as it relates to a cash value life insurance policy. A withdrawal also reduces the balance of any qualified account like an IRA or 401k. And what that means is the dollar amount you end up withdrawing from either account impacts the compounding or how your account compounds from that point forward. Again, very simple. If you have 100,000 and you withdraw 10, you have 90 left, which means you don't have 100,000 compounding for you, you only have 90. And so this also may trigger a taxable event. In cash value life insurance policies, if you borrow in a cash value life insurance policy, if you withdraw anything above your basis, what do I mean? Well, using the same $100,000 scenario, if you've put in 40 or 60,000 and your policy's cash value has grown to 100, so you've got 100,000 in cash value based off the 60 you've put in this policy, and you want to withdraw 50,000. Again, you put in 60 and it's grown an additional 40, which means you have a total of 100,000 in the policy and you want to withdraw, let's say 70,000. Again, I'm just making up numbers. You put in 60, it's grown an additional 40, which means now you have 100,000 sitting in your cash value and you want to take 70 out. When you withdraw 70, because you put in 60,000 of that 70, you won't owe any taxes on that 60. But that remaining 10, that 10 is coming from the growth in the policy, which means you will owe taxes on anything above your basis. So we don't want to withdraw from a cash value life insurance policy because you may incur a taxable event in doing so, and it impacts the ability of how your policy grows. But getting back to borrow, when you borrow from your policy, you're borrowing against the cash value. Borrowing against versus borrowing from is also something you should pay attention to because words matter and how this is communicated, how your policy is structured matters. When borrowing against, you're not impacting the growth when you borrow. When you borrow from, you are absolutely impacting the growth. Here's my example. You guys know I create properly structured, self-directed 401ks. One of the cool pieces about having a self-directed 401k is your ability to borrow 50% of what's in it up to 50,000. But when you're borrowing as it relates to your 401k, you're actually borrowing from. So using this same $100,000 example, if you've got 100,000 and you're borrowing 50% of what's in it, you're borrowing 50% from the 100,000. That means the balance on that $100,000 self-directed 401k drops from 100,000 down to 50. That 50 is no longer there working for you inside that self-directed 401k. So borrowing from versus against is also another one of those, again, things to know. What you want to do is mark this live so that you can come back to it to make sure that when you're dealing with an agent, wherever the agent's from, whoever the agent is, that you understand these terms absolutely matter and understand what they mean. So what would be required of a properly structured cash value life insurance policy to be able to receive supplemental income? What needs to happen inside that policy? What does it need to look like? Well, the growth of the cash value has to outperform the amount being used for supplemental income. Using Kyle Busch's example, if he's put in $1 million a year, the growth in that policy, the growth in the cash value growth inside that policy, if he's wanting to take $800,000 as income by age of 52, the growth in that policy over time, the total growth in that policy has to outperform the amount that he's wanting to take. Meaning, his policy has to be doing better than $800,000 a year for him to be able to take $800,000 in income. Hard stop. And if that's not the case, then that $800,000 is impossible. So the growth of the cash value has to outperform the amount that you're wanting to take as income. That's number one. Number two, the cost to borrowed cash value, again, you're borrowing the cash value as supplemental income. I'm going to use it to be able to pay my bills and live off of. It has to be less than the overall growth rate. This is specific to an IUL because, well, not necessarily. This is specific to cash value life insurance policies, both whole life and IULs, because if the dollar amount you're borrowing as supplemental income is not less than the overall growth rate of the policy, what you could cause in that case is you could cause your policy to implode. You could cause your policy to eat itself, meaning you're taking the growth that's happening in the policy, and as fees happen and the cost of insurance changes, and as you get older, the growth in that there's not enough growth in that policy to compensate for the dollar amount that you're using. So cost to borrow cash value of supplemental income has to be less than the overall growth rate. If I am putting this in terms of Kyle Busch's policy, if we're doing $1 million a year, and my goal is to access 800,000, I need for that growth inside of my policy, I need that 800,000 to be something less than what my policy is actually making. And then the most impactful piece to me is the fee structure. I don't care what the policy is, the fees inside that policy have to be decreasing, because when it's time for you to start taking income, again, because you're impacting the growth on that policy over time, because you're taking a certain portion of the cash value as income, we need to make sure that the growth inside that policy, the fee structure inside that policy, is decreasing. It's getting smaller. So in order to be, again, just to recap, in order to be able to take income from your policy, what is required? The growth of the cash value has to outperform the supplemental income. The cost of borrowing has to be less than that overall growth. And ultimately, the fee structure has to be decreasing. The second item that was identified in the list of opportunities was, the expectation from Kyle's perspective was the policy would be able to self-fund itself after a few payments. What does that mean? Again, the policy would be able to self-fund after a few payments. I think as we learn more about what happened in this policy, everyone's going to have their perspective on what some of these things mean. I'm going to give you my perspective on what self-funding means, because I think there's a few different ways to look at it. But when I hear self-funding, what I hear is the policy premiums that you are currently making, you are now going to stop making those policy premiums, and those policy premiums are going to be made from the policy. So if I'm contributing $1 million, I'm going to stop contributing that $1 million, and the policy premium is going to be paid for the growth of the policy, which means they're going to be made by the policy. I'm making policy premium payments from the policy itself, not out of my pocket. That's what I think of when I think of self-fund. So is it possible to have a policy self-fund itself? At what point, what does the structure have to look like in order for the policy premiums to be made by the policy and no longer you? Yes, ma'am.
Okay, let's pause here for just a second, because I need some clarification, and I think others would appreciate it as well. When you talk about the policy paying the premium from its own source,
the growth, the cash value in the policy is now supplementing the premium payments. That is correct.
Okay. Couldn't this also, if you were to just go next door to this concept, hyperfunding?
So I think hyperfunding is where I'm putting such a large amount in that I am never putting another dollar amount in beyond that. And that is actually illegal.
Right. But
It's
if
an illegal term that one is a legal action, and the term itself is not approved to do inside of cash value life insurance policy.
okay, but if your words matter, right? Words matter. If you are saying self-funding, but you're not saying the other part, right? Which is you got to put more in than you've got to do your part.
Right. You have
And
a responsibility here. And if the goal is to put my policy in a position so that there's enough growth in it that it can pay premiums on its own, there's a role that you play in doing so. Absolutely.
right. And if you do not, and if the concept is just the less I need to do for the more and the more I get, and the term self-funding could also be somebody talking about hyperfunding. True or untrue?
That's true.
Okay.
That's true.
So again, this is where like words matter a lot.
Have a large impact.
Because, and this is why I'm bringing this up, in some of the IBC conversations that we have witnessed in real time going down, people say, why can't I just borrow from my policy and put it back in as premium?
Right.
Why couldn't I just do that? And this is the concept of leverage, right? It's not a new thing, but suddenly the IBC community have invented it, and it's called taking a policy loan to reinvest as premium, but not telling the insurance company that that's what you're doing.
Right.
That's illegal.
It's a no-no.
Yeah, and and the other part of that is if you're doing, so here's one part. We're going back to words matter for just 2 seconds.
Mhm.
Promise I'll make this fast, guys. If somebody, it could have been that they heard borrow. They only remembered withdraw. And so it wasn't the agent's fault that when years had passed and they went to go and have a conversation about their policy, even the agent on the phone, right, that they talked to, if they called up.
Well, what's the process?
This is how old I am. I'm still doing phones like this.
But this is important though, because what's the process? If you wanted to borrow against your policy, what do you do?
Right. Well,
Are you calling your agent or are you calling the life insurance company?
I don't know. I'm calling somebody.
Calling the life insurance company, not your
Yep.
agent.
Yeah, exactly. I'm calling
So
the life
when-
insurance company.
When the life insurance company picks up,
Yep. Hey,
if you don't say the right words, they're going to do whatever it is you ask them to do.
hold on, because the life insurance person on the phone, right? They're like, can I help you?
Mhm.
I need to get some money out of my policy.
Finish the sentence.
You want to withdraw the funds from your policy? Yes, I want to withdraw funds from my policy.
Then guess what? They are going to follow your direction and allow you to withdraw from your policy.
Okay, they're not going to say, sir, ma'am, would you like to, did you mean borrow? Did you mean borrow? Because I see a note in here that says that your plan, what you got going on is you would be borrowing at this time. They're not going to say that because they're not a part of your strategy and they don't care. They're what they got call times and stuff, right? And they probably got a break coming up. Like they don't care about you. And so do you want to withdraw? That's what you want to do? Okay, I'll help you do that. So I'll move on to the next caller. Let me just put the phone down. Put it down, girl. If you're not, my point is sometimes it's not the agent's fault if the client gets confused, and we all get confused about things. It could be that there's something really wrong going on in your life, like your house just burnt down. You're in California. You're going, you know what? I need to access my leverage. I've got to make some moves here because my life is in crisis. I need help. And you happen to use the wrong word. That's a problem. That's not the agent's fault if that happens. That's what I'm saying. But if that person is truly educated, if that person has support, they have someone they can call.
Just to make sure that you are prepared, that you have the right tools, that you have the right understanding, that you understand what it is you're buying.
Right.
That's the key.
And so that's where I just want to throw that in there, that it doesn't necessarily always mean that it will run if you hear somebody talking about this, because it's not always true, right? It could just be that there was a moment, confusion happened, but this is where these these terms sometimes can get convoluted, and people implementing a strategy that they thought that they understood, they had every bit of a good intention, but then they just confuse some of these things. This is what happens in IBC all of the time. They make assumptions or life changes, and they don't understand how that could impact a policy, impact the policy as a whole, right? 10 years down the line, they had no idea where. They just heard, I could borrow in year 1.
Right. What's the impact of you borrowing majority of your cash value in year 1? Do they finish the sentence and break down what that means?
Right. But if something is happening in your life and this happened and you go, hey, wait a second, I could borrow 90% of my funds in year 1 because my agent said that I could. They didn't say the other part, but that's not the point. The point is they remembered the part that mattered when they needed to use it. And that's the part about being self-directed that we're talking about over here. Self-directed is that you are in control and you have tools available to you so that when you need to use them, when you want to use them, hopefully more than when you need to use them, right? When you can use them, when it makes sense to use them, that you can make confident, educated decisions.
Or at least you can go to the place to grab the information so that you can make the confident decision.
Yeah, true, right, yeah. But the point that I wanted to make is the withdrawal versus borrow. Sometimes it is just in someone being confused in that moment, which is fair. That's human, right?
Right.
What we're talking about though is not being human. This person was trusting someone to lead them into wealth generation in a sense, and lead them financially with all of the other claims that they were making as well, which is in that docket. You guys can read that. And if he wasn't aware of what the strategy like this was or was not, then this is where a lawsuit has to come into play. This is not a defense for what an IUL is versus a whole life, or some sort of defense for IULs. I'm trying to mind my words here carefully.
Applaud that.
Yeah, thank you. This is, I think, where I can understand where whole life agents just tear up IUL policies, and they do not like them at all as a whole. Like, they're making blanket statements, and it's because of things that happen like this.
Right. Because it is not, if you're looking for set it and forget it.
Yeah.
This is not that. If you're looking for, I have no responsibility to make sure the person that is buying this policy understands the inner workings of what this looks like. Welcome to This Is Not That.
Welcome to This Ain't That. We have a lot of really great comments in the chat going on, and if you are, I would really love to know your opinion on this, if you are aware of this at all. So I'm going to jump back in the chat and let you carry on from here. But anyway, the point was probably lost by now. It's in the words matter, and that sometimes it is not necessarily the agent misleading necessarily. It's this, we're all human too.
Right. And that's where having the information available is key.
Yeah.
It shouldn't be behind some paywall, or it shouldn't be hidden behind pages of a document. It's out in front. Hey, here's what you're dealing with. Here's why. Here's what you need to know. And if you have any questions, guess who you come to, right?
Yeah. Yeah. Support does matter. Okay. Here we go. Let me find you again.
Okay. So hit that. So for the self-funding piece, so the second item was what's the expectation was this policy would be able to be self-funded with just a few payments. And the point I want to make with this is, one, understanding what that means. And again, my definition of that is policy premiums can be paid from the policy itself. Okay. When is that even possible? And if we're just talking math, I'm not saying whether or not your life insurance company allows it. I'm not saying whether it's an ethical thing to do, none of that. It's just logically, mathematically, When is it okay? When would you have enough cash value in your policy for this to even be an option? At what point does that occur? And for that, I wanted to kind of jump into a comparison between two policies, a whole life policy and an IUL with leverage, both being funded with the same dollar amount, $30,000 annually. 2,500 a month or 3,500 or 30,000 annual, doesn't matter. But the bottom line is the comparison between, and this is an actual whole life policy of a pretty prominent influencer who was, I'll call it, taken advantage of, very similar to Kyle Busch, and was quite upset about it. So we broke down his whole life policy and tried to identify where the opportunities were. But again, when would either of these policies, the only question I want to answer with this policy as of right now is, when would either of these policies be able to be self-funded? And so we have to make some assumptions. Assumption number one is, for the whole life policy, I'm going to assume a 5% dividend growth and a 5% loan rate. And this is me being very generous. Take a look at your whole life policy. What is the growth and what is the loan rate? Is the loan rate larger than the dividend growth? In most of the policies I've seen anywhere between 5 and 9% on the loan rate, and the dividend growth being somewhere between 4 and 5.75. So if your loan rate is higher, that's a problem. But let's just strip that away for now. Let's assume the dividend rate and the loan rate are the same. So what I'm saying is, at what point would you be able to take $30,000 in growth in the policy and put that in brand new premium? And again, I'm not getting into whether or not it's the right thing to do or whether your life insurance company would allow it. I'm just looking at math. Mathematically, where in the policy? Why am I doing that? Because Kyle's assumption was, after a few payments, he would be able, his policy would self-fund. After a few payments, his policy would be able to be self-funded. That's the expectation. So my question is, when would that occur in a policy that, again, is supposed to be structured correctly to be able to do what you want? So let's look at this whole life policy, $30,000 a year. And what I'm getting at is, if the loan rate is 5%, at what point can I take a loan from my policy and it not impact my growth, and I could take that loan and use it as premium? Again, not getting into the semantics of why, I'm just mathematically, when is that possible? Well, it ends up being right around here. If you, at this point, based off the loan rate and the growth rate, what's accessible to you in cash value, it takes about 20 years in a policy of putting in $30,000 a year for the next 20 years. At this point, you'd have about enough cash value in your policy to supplement for what your annual premiums would be. It would take about 20 years. It is not a couple of payments. And if it's an IUL with leverage, if it's an IUL that's properly structured with leverage, meaning starting in year 3, there's leverage added to the policy and so on. Again, I'm not getting into the structure of what an IUL with leverage looks like. My point is, at what point would you be able to then supplement the payment? And it would still be around that same $700,000 mark. It'd be around here. So somewhere around year 15. So year 15, year 20 are those moments where you would be able to potentially take the growth inside the policy and use that growth to now pay for the policy premium. Now, as it relates to a leveraged IUL, that's not 100% true. But what I wanted to identify is where the opportunity is located. It's right around this point. But here's the truth. If you were to put these numbers into the calculator and break down, because this here's why I share this. This illustration illustrates these dollar amounts at about 0.5%, which is about 5.5% less than what it actually illustrates at. But based off this illustration, where is the opportunity for you to be able to use the growth inside the policy to be able to pay this $30,000 a year premium? It's somewhere around year 15, year 20. If we were to look at actual dollar amounts, it actually hits somewhere around year 10. Here's my point. Mathematically, in order for this policy to be able to pay for the premiums itself based off the growth in it, it definitely is not a few payments. It's going to take anywhere from 10 to 15 to 20 years to do so. And your argument might be, well, Kyle was putting in $1 million. Okay, add a zero to these numbers. If this was 300,000, the break-even point, the point in where you would be able to supplement the income or supplement the premium payments using the growth in the policy is still the same. Add 2 zeros, it's still the same because it's math. Mathematically, in order for this to happen, it would take somewhere around 20 years in a whole life policy, 15 years in leveraged IUL, and if we use the actual growth over time, which I'll dig into as well, it will take somewhere around 10. It'd be year 10 is where that would happen. And again, the answer that I want, or the question that I want answered is, when will my policy be able to self-fund? It definitely isn't a few payments. It's somewhere around 10 to 20 years to do so. So if you're being told that your policy can self-fund itself, understanding when that is possible, when that is even possible inside your policy is important. And again, this is based off and again, I made some assumptions in this IUL with leverage as well, using a 7% crediting rate and a 5% loan rate. Again, I'm being fairly generous on both of these as to what this looks like. But the bottom line is, it's something greater than a few years. It's something greater than a few payments. It's somewhere around 7 or 10 to 20 years in order to be able to do so. So again, that's the second question. The third was unrealistic illustrations, misleading projections. And I want to focus the attention on misleading projections. This is where I see whole life people celebrating, because the projections inside whole life are pretty stable and consistent. What the guarantee you get inside of a whole life policy is guaranteed growth. You get the guaranteed 5% growth, guaranteed dividend payout on the amount that you're contributing over time. So there's not an opportunity for misleading projections. But here's the thing. If we're going to look at the words misleading, a lot of times the misleading problem is hiding in plain sight. It's not being hidden from you. There's not something that is being, there's nothing being deceptive around your policy. It's just, you have to understand how to read this illustration. Because here's what I mean. If we're talking about misleading projections, with the whole life policy, the projections are fairly constant. There's nothing misleading about that. But if I'm putting $30,000 in this policy and I have a total net cash value, and here, I'll make this even bigger. If I'm putting $30,000 in this policy and I have a total net cash value of $18,766, that means I put $30,000 in the policy. How much cash value do I have access to? $18,766. There's about $12,000 in cash value that is missing. So yeah, the projections might be stable, but where is my money? Where is my access to my cash value?
Yeah, no doubt.
So again, I go back to knowing how to read the illustration is key. And as it relates to a leveraged IUL, again, it's the same $30,000. Going into a leveraged IUL, how much is working for me? $29,435. There is a difference of about $600. So I put in 30, I have $29,435 working for me. Which is more misleading to you? The IUL that, hey, I haven't disclosed how the crediting rate functions and occurs inside this IUL. Is that more deceptive, or is it, I lost $12,000 of my cash value, which is never coming back? Which is more upsetting?
Well, I'm gonna tell you what else is more upsetting. When you see that there are particular companies that will write a policy in a particular structure, right? They have something unique about the way that they will structure things, and other agents will go, "We got that IUL at home."
Right.
You know,
I can duplicate this.
I can do that. Yeah.
I can do this.
You don't need this company to be able to do this particular thing. We have seen so many videos of people saying that exact same thing, But the problem is, this is where that creativity thing, we got, McDonald's at home. Well, now you have to know the recipe in order for it to come out the exact same. Now you have to be the one to mix up all of the ingredients. You have to be the one to understand all of the steps that are involved. And the problem is, there's no support system for creativity, right? In how people are out here structuring things. So in this particular case, he had to be the one to pull the triggers, push the buttons, pull the levers, right? He had to be the one to do all of that. And he's also responsible if it doesn't get done. There's no support system. The company's not even supporting him and doing any of this stuff because this is his policy, his client, his structure. This is something he came up with that the company, I guess, gave the okay on, right? They didn't say, we will structure policies in this form. They said, we will do it for this client. We'll do whatever you guys want to do as long as you're bringing in clients. I guess that's what we'll do. They don't have a standard that says, no, these bumpers are in place for a reason, and you can't go outside of these. Go somewhere else if that's what you want to do, but we're not going to do that here. In order for you to structure this in this way, in order for you to structure or represent this type of structure, you have to do it in this particular way. There aren't any bumpers in regards to those other companies. However, there are companies who have taken a stand because of the abuse from agents, particularly, that have said, we are not writing a policy like this. So if you do, you're writing it with the intent that the client would then go outside of our standards or outside of what we are saying is legal from our standards. And that will cause the agent to get in trouble, and it could cost you your entire policy because you broke the rules.
Right.
So if you're not going with a company that has standards in place, a company that has approved a process and has support for that process so that you are not reliant on somebody pushing buttons, having to manually push buttons and pull these levers for you, then you're subject to this every single time. But how does a client know?
Right.
How do you know? And if like this were in particular, when the thing that's missing out of all of this is the fees page. So you can see that there's money missing if you're paying attention, but where is it going?
We will definitely hit that.
Okay.
So the unrealistic illustration, misleading projection. So this is an IUL, this leveraged IUL portion in this document is what I created. Using it at $30,000 a year, this is how it would perform based off a leveraged IUL. Notice, if I'm putting in $30,000 a year, and I've got accumulation value of $29,435 at the end of year one, notice by year two, I put in 60 total. I have more than 60,000 available. The break-even point inside this policy is year two. So as it relates to understanding your IUL projections, we have to understand where those IUL projections come from. And when we're talking about projections, what we're talking about is the crediting performance rate. This is something specific to IUL. So as it relates to Kyle's issue, Kyle's policy, Kyle's IUL that imploded or isn't performing the way that it needs to, he had mentioned, hey, the projections were misleading. So when an IUL is created, where do those projections come from and what is the basis for that crediting performance? Well, the thing about me is I'm not here to reinvent the wheel. All, not some, not a few, not every now and then, every IUL I create has the same crediting structure. We use the S&P 500 for that crediting structure. And what this means is, this is where we have to get into some of the weeds of an IUL around when you contribute to an IUL, the guarantee inside of an IUL is there's no loss on the money you've contributed and there's no loss on the growth of the money that you've contributed. But that IUL, is contributed into the general fund. There's a dollar amount that's taken from that general fund and a call option is purchased. A call option is purchased with using a certain index. There are many indices that you can use as it relates to IULs, but the IULs that I structure, that I create, all use the same. Whether you're looking at my policy, whether you're looking at my kids' policies, whether you're looking at my clients' policies, it doesn't matter. They are all structured the same and they all use the same crediting structure. And that is use of the S&P 500. Why? Why do we use the S&P? Why don't we use B of A? Why don't we use these other indices? Why? Because the S&P 500 is proven. What was the crediting structure used for Kyle's policy? We don't know. But it's clear that it was misleading and what was told was happening wasn't. The reason we use the S&P mainly is because it's one, readily available, and two, it's tried and true. We have the data since before the Great Depression as to how the S&P 500 has performed. So if you wanted to look at the last, again, got this policy when he was 35, 5 years ago. So ideally, he would have started his policy somewhere around here. If his policy was, the crediting structure was set up in the S&P 500, how it would perform means there are certain guardrails put around it. And how the S&P performed is one thing. The crediting inside of your policy is something different. That crediting rate has a cap on it. I have met with a lot of clients who don't like the fact that the crediting rate inside of the IULs that I structure using the S&P 500 has a cap of 10%. They don't like that. But here's what that cap does for you. It provides security. While there's a cap on the growth, there's also a floor on the loss. If you had an uncapped IUL, if Kyle had an uncapped IUL, he may have taken a 20% hit in the midst of the growth of his policy. Do you know how long it takes to recover from a 20% loss? It is not a few weeks. It is not a few months. It is several years for you to be able to just come back to even. But not being able to participate or not having to be able to participate in any of that loss allows you to build uninterrupted compound interest and growth. So we use the S&P 500 for several reasons. Why? It's tried and true. And the other is because we know what that data looks like over time, so we can also backtest. I can't predict the future, but I can tell you how it's performed in the past. Yes, ma'am.
This is the same risk, though. We're not talking about market risk in terms of IBC and using your policy to invest in other markets or industries. So for instance, you take out a policy loan and this is how you're going to invest in real estate, but you're new to investing in real estate and you didn't understand that the deal that you just walked into. And now all of a sudden you have lost money. You are not profiting from this deal and you cannot pay back from this as quickly as possible. This is no different.
Right.
But this is the part that's not said within that conversation, because a lot of people get eager to jump into and utilize a concept like infinite banking for two birds, one stone, and all that's promised. I'm just referring to misleading information, misleading projections. One is the constant IBC projections of how much you can not even consider, how much you could earn or what your policy could do and how much income you could take without even considering how you're using it in the process.
Let me restate what I think it is you're
Okay.
saying. I think what you're saying is, and again, using real numbers, if I've got $100,000 in my whole life policy and I want to borrow a certain amount to be able to go do infinite banking, buy a property.
Yeah, your illustration is not going to reflect what's going to happen and the impact of that.
Right. And so if in 5 years, 10 years, 15 years, my objective was to be able to take some type of supplemental income,
You're not going to.
if I have impacted that compounding over time by borrowing against my policy and not truly doing infinite banking, which is paying myself back with interest, it will impact that 15-year point when I want to take income, because that dollar amount may not be there.
Right.
Right.
But that nobody's talking about that. They're talking about access. They're talking about freedom. They're talking about all these other things. And here's why this is important in this particular case. When he started, they weren't talking about in year 4, you're going to do a 1035 exchange and you're going to kill these other policies and restart this policy. That wasn't part of the conversation. So misleading projections, yeah, especially if this event happened and now the entire course has been changed, right? Or rerouted. So that's one. But there were other factors involved in changes that had happened. And a lot of those things, again, I go back to, you scrub back and grab that QR code and go kind of comb through that filing yourself to learn what was promised? What was the plan? How did this all start? What was the plan? What was said? Who was involved in what was said? And then what happened? Because I don't think that this can ever be a whole life versus IUL conversation, even though even Rosalind, she was saying in the comments that her local news station, Rosalind, I hope it's okay that I put this comment up here. Reporting from my local news said IUL should not be in anyone's portfolio, which caused me concern with my policy. Just want to be sure I made the right decision. And this statement like this being made, especially from your local news station, is these blanket statements is because there are people behind here who have to push the buttons and pull the levers. And if they're only lasting a year, they're not going to be around to push any buttons and pull any levers for you. And the company is not going to understand. They're going to leave it in your hands to then push the buttons and pull the levers. This is what you wanted, because the structure and the support is just not there. But this is we got IUL at home. We can make IUL over here. And it's just two different apples to oranges to even be able to compare. But it's unfortunate because big, huge claims are being made about a particular product, which is causing a lot of people concern because they don't understand the difference.
Right.
Some people, though, they should be concerned, and you should get your policy checked out. You should have someone look it over or teach you how to read it so that you understand what it is that you have if you aren't feeling confident about that right now.
And again, over this last year, I've probably looked at 150 policies. This is something that I actually enjoy doing because it only takes 30 seconds to understand how your policy is structured. And especially as it relates to IULs, there are so many different levers and things that you can do. It's a process that has to be managed. So as it relates to, again, this unrealistic illustrations, misleading projections, you have to understand where the projections are coming from. The projections are coming from based off the crediting performance rate. And in the IULs that I create, it's only coming from one place. That is the S&P 500. Why? Because it's tried and true, and this is the performance over time. But how is it illustrated though? Meaning the performance is coming from the crediting rating of the S&P. This is what you're looking at here is the actual illustration based off that $30,000 performance. This is the baseline illustration. This is the illustration with no leverage. And so if we're talking about $30,000 a year, how is this $30,000 illustrated? Well, there are three buckets. There is a guaranteed bucket, there's an alternate bucket, and then there's a non-guaranteed bucket. What do these buckets mean? Well, being illustrated based off a 0% means if the market crashed every year, that means that S&P 500 performance wouldn't be green, it would be red. If the market crashed every year, your crediting would be 0. So if you received 0% crediting every year in this policy, there's details as to how that will perform. But how realistic is it? How close to actual is the market crashing every year? How many years consecutively has the market ever crashed? 3. The alternate scale is saying, okay, maybe the market doesn't crash every year. But what would happen if the market crashed every other year? How realistic is that? It's not. So the non-guaranteed section is illustrated at 6.33%. What's the actual? Well, I just shared that with you. The actual performance over the last 22 years is sitting right here. Based off the actual performance of the S&P, the cap is 10. If you were to average all of these, it ends up being somewhere around 7.8%, if I'm not mistaken. But the moral of the story is the average is around 7.8%, but the actual crediting over the last few years have been 10. But this is illustrated at 6.33. So the idea is under promise so that we can over deliver. We are illustrating at this 6.33 and basing off this performance, the accumulation value, the surrender value is based off something less than what's actually occurring. The illustrated rate is 6.33% compared to an actual, again, 7.8% on average, but it's somewhere between 7 and 10%. This is the baseline policy, no leverage. Well, what happens if we were to add leverage into this policy? This is how the structure breaks down inside this policy when leverage is added. Again, this is a leveraged IUL. I'll make it bigger. You put in 30,000 in year one, no leverage added. You put in 30,000 in year two, no leverage added. But at year three, when you put in 30,000, the life insurance company puts in 30,000, which means there's a total of 60,000 working for you. This is how the leverage gets added into this policy.
But he didn't have a policy like this.
He did not. What I'm sharing with you is the misleading piece around how things are illustrated. It doesn't matter whether we're talking about a baseline policy with no leverage or a leveraged IUL, which is what I create. How it's illustrated is the same, is my point. It's 0% based off what happens if the market crashes every year. It's the alternate based off if the market crashes every other year, or it's the non-guaranteed is illustrated at a 6.33, which is still less than actual. So my point is, if we're talking about comparing IULs to IULs, you want to understand how it's illustrated and where this information is located. It's not hiding, but you have to understand how to read your illustration. You have to understand where the information is located and how your policy is impacted based off that information is the key. And so the fourth item was lack of disclosure of sensitivity to cap cuts, non-guaranteed elements, policy charges, and I grouped 4 and 5 together because it just speaks to policy structure, costs and risks not fully disclosed, cost of insurance, admin charges, performance risk. So what I took away from these 2 items is structure. How your policy is structured matters. And whether we're talking whole life or an index universal life insurance policy, doesn't matter which one, it's structure matters. So knowing how to read your illustration is really important. Knowing what questions to ask. And if you look back, maybe it's 3 lives, we covered this in depth. And we focused on whether it's a whole life or an index universal life insurance policy, what are those pieces you should be looking for? And what is it you can control and not control? And so we identified the policy design mistakes. And specifically as it relates to policy design, you can't control any of this. You can put me back up on the screen as well. There you go. You can't control any of this. Whether you're underfunded or max funded is a question you want answered. What does that mean, whether I'm underfunded or max funded? How much life insurance are you buying based off the dollar amount you're contributing? That will determine whether or not your policy is underfunded or max funding. Are you buying the maximum amount of life insurance policy for the dollar amount you're contributing? For putting in $30,000 a year, am I buying $1 million in life insurance or am I buying $500,000 in life insurance? What is that amount? And that is something that, again, you want to ask those questions to understand where you are. How much is working for me in year one? Why does that matter? And again, whether it's a whole life, variable life, universal life, it doesn't matter the policy. You want to know if I'm putting in $30,000 a year, how much of that $30,000 is actually working for me? In this policy, we saw that the whole life version, you put in $30,000, you got $18,000 working for you, $18,000 accessible, that's $12,000 gone. On the IUL with leverage side, there's about $600 gone. That's a huge difference. So understanding how much money is working for you in year one, is the death benefit increasing or level? This was one of Kyle's main issues. This is one of the identifiers that was listed in the court documents. Is your death benefit increasing or level? Why does that matter? Well, an increasing death benefit means the cash value is building. A level death benefit is saying, hey, I'm ready to start taking distributions of income from this policy, and so therefore, policy loans in the form of supplemental income from this policy. And so I want it leveled so that I am not incurring more fees than necessary inside this policy. So when the policy is increasing and when the policy is level is very important. Product type and fee breakdown. I'm going to spend a lot of time here. But product type is saying, what type of policy did I get? What are the levers in this policy? How is this policy different from a term policy? Or what are the inner workings of this policy that makes this different? Whether we're talking whole life or an index universal life insurance policy, doesn't matter. Want to understand the product type and want to understand how fees are broken down in my policy. And if your agent is saying your policy doesn't have fees, that should be a red flag for you. Because I get that a lot from people who have whole life policies. They come to me going, my agent told me my whole life policy didn't have any fees. Well, using this one as an example, if I put in 30,000 and I have 18,000 of cash value, where did the 12,000 go? Call it all commission if you would like. To me, that's a fee. Why? Because my money is gone. So understanding your product type and understanding the fee breakdown, and then the break-even point. At what point is my contribution into this policy, does the cash value equal what I've put in it? To me, that's a huge concern for Kyle Busch. If I put in 5 million, at what point do I have 5 million or more working for me in this policy? It's important because if my objective is to take supplemental income, where this break-even point tells me where my money starts making money. And then lastly, it's the agent who designed this policy. You, as the consumer, can't control any of these items, but you can ask better questions around how your policy functions in each of these pieces. And again, we covered this a few lives ago, so I'm not going to dig into the specifics of what this looks like because I know it's busy, but the bottom line is your policy underfunded or max funded? How much is working for you in year one is easily identified everywhere in both of these policies and where it works for you. So my suggestion would be slide back a few lives and dig into that detail. But what I want to focus on is what is not broken down here. While product type is just saying, is this an IUL or whole life policy? What is not broken down here is the fee breakdown. And the fee breakdown in policies that I create, in IULs that you can expect to receive from me, absolutely have a full fee breakdown because there is nothing to hide. You should know what the fee structure looks like inside your policy. And I'll zoom in, but this is both the regular IUL with no leverage, and this is the IUL with leverage. There is a fee page inside the illustration of your policy, and it's standard. You should know how to get to it, and you should understand what it's saying. So in your policy, whether it's an IUL, whole life, universal, variable life, doesn't matter. Do you know where to find your fee schedule? Does the fee schedule even exist in your policy? So what I wanted to look at was the breakdown of again, a baseline IUL, same $30,000 a year, no leverage. There are 3 buckets of fees. All cash value life insurance policies have the same buckets. There's a premium charge, expense charge, and the cost of insurance. These are the 3 buckets. How that fee structure is broken down matters because the premium charge is really not much you can do. The premium charge is saying if I contribute $30,000, that premium charge is based off the amount that I'm contributing. If I stop contributing at age 51, that premium charge of $1,017 would go away. But as long as I'm contributing into the policy, there is a premium charge associated with it. The cost of insurance, there's really not much you can do about that one either. Hey, based off my age of 40 to 41, there's a cost of insurance of $448. As I get older, that cost of insurance increases. It increases based off my insurable interest. So as I get older, it costs more to insure me. It's just factual. The key to making sure the fees inside of your policy are not eating up the policy is this little buddy right here, the expense charge. The expense charge is where your agent's commission lives. The expense charge is the cost of the insurance itself. The expense charge is the cost of underwriting. And what happens is that expense charge is actually paid up front. And then the life insurance company spends the next several years recouping what they've expended. And so in this case, the expense charge starts out at $1,000 a year based off the $30,000 contribution. But by year 5, it drops down to $280 a year. And then by year 15, it drops down to $96 a year for the rest of your life. Again, this is a policy with no leverage. What does this look like in a policy with leverage? Well, even with leverage, it's still the same bucket of fees. Notice at $30,000, the premium charge didn't change. But when my $30,000 plus the leverage of $30,000 coming from the life insurance company gets added, that means the contribution into this policy is now greater. There's now $60,000 of premium going into this policy. Well, now the premium charge is based off $60,000 of premium. And then when additional leverage is added in year 5, $90,000, that premium charge is now based off 90,000. When additional leverage of 120,000, meaning 90,000 of the life insurance company's money is added on top of my 30, the premium charge is based off that. The premium charge is based off the amount being contributed. Hard stop. The expense charge is also based off the amount being contributed, but notice what happens at year 15. Regardless of how much leverage is being added into this policy, the expense charge is still $96 a year from year 15 forward. So regardless of the amount going into the policy, notice the structure of the policy didn't change. If there was a 1031 exchange done somewhere in here, that might reset the clock, which would cause this expense or the expense charge to change, which would then push this date. But that's not what happened here. And that's not what we would want to do. If you're wanting to do a 1031 exchange, you want to do it at the start of your policy so it doesn't impact the performance of your policy going forward. I thought it was. 1031 is in real estate, 1035 is in insurance. 1031 in real estate is basically saying, hey, I'm taking a property and I'm moving that property and not being tax impacted. And yeah, so I thank you for that, because
Yeah, that was my bad.
Bothering me the whole time. But
Yeah, Gabo caught it earlier, and I just didn't want to interrupt you.
Thank you, because it's been bothering me. But hey, I'm gonna rock with what it said on the sheet and let's go. But anyway, the moral of the story is the 1035 exchange is something that you want to happen early on. Is at the end of the day. And then the expense charge, again, my point is whether we're talking a policy with no leverage, a baseline policy, or a policy with leverage, does not matter. It's the same buckets of fees, and how those fees are calculated is the exact same. I just wanted to make sure that is clear. And last thing I wanted to cover is number 6, which is negligence and failure to supervise. I think this is all encompassing. I think everything that we've discussed, if I'm the person that wants to purchase a policy, some type of IUL, I shouldn't have to be concerned with all of this. What we want to do is arm you with the questions to ask. But it's the responsibility of the agent creating this policy as to how it functions and whether or not the answer to these questions are the correct answers. So the negligence, and failure to supervise, a leveraged IUL, an IUL in general, is not a set it and forget it product. It has to be managed. The agent that creates this has to follow it through. You should be meeting with your IUL agent annual, if not annually, every 6 months. But I'd say in most cases it's annual, right around your anniversary date. There should be some email, some text message saying, hey, it's your anniversary. Let's take a look at, let's review how your policy's doing. Let's make sure that it's doing everything that we laid out, how it was going to perform based off whether it's a regular IUL or an IUL with leverage. We want to make sure that it's meeting all of the correct criteria and checking all the boxes. This is a strategy that cannot be a set it and forget it. It be created and then you sent on your way. It has to be managed. And so what does that look like? What does managing of this strategy look like? Meaning the agent that creates this policy for you, what do those check-in points, what needs to happen during those check-in points? Well, that annual touch base I should be answering the question, is your policy performing? Yes or no? Based off the crediting strategy, and again, in my case, all of them look the same. We're using the S&P 500. So based off the crediting strategy, is it performing or not? Yes or no? And if the answer is yes or no, why? Why is it doing well? Why is it not? Did the market crash? When did it crash? What was the impact? And these are annual point to point. So understanding how your policy is performing is critical. And how does the policy compare to the illustrated rates? In the illustration, you said it was going to do A, B, C, and D. How's my policy performing based off what the illustration says? And as we kind of mentioned, there's guaranteed, alternate, and non-guaranteed. Non-guaranteed is being illustrated at 6.33%. At a minimum, we should be hitting that 6.33% or beating it. And if we're not, why? What adjustments are required? If things aren't performing, what adjustments need to be made? If my goal is to be able to take income when I hit age 52, are there any adjustments I need to be making so that I can hit that objective? Are we on pace to be able to accomplish a goal? And then is it time to add leverage? In my case, when I'm creating an index universal life insurance policy, it's only an IUL with leverage. So when does the leverage kick in? And is it a jump, or am I just adding leverage as additional premium? Which one is it? When is that time? When does that occur? And it alternates. Year 1, year 2, not much is happening. Year 3, are we just adding leverage along with my contribution, or am I jumping the policy? What does jumping the policy even mean? Are we increasing the death benefit and adding additional premium that causes us to now purchase more life insurance so we can create more room and not make the policy? Are we jumping the policy? But these are the again, there are many other questions that can be asked, but I would say high level, these are the 4 questions you want to make sure you are answering when you are meeting with the agent who created your policy on an annual basis. If you have to track your agent down, that's probably red flag number 1. Your agent should be reaching out to you on an annual basis to say, it's time to have this discussion. And here's the truth. If we are not adding leverage, maybe we don't really need to meet. Maybe we just need to identify how much leverage is being added, and there may be some documents that need to be signed so that leverage can be added to your policy. Because again, this is a strategy, and an index universal life insurance policy where leverage is being added is a strategy that has to be managed. We have to work together in order for your policy to properly execute, which means there's some things, I can't just arbitrarily throw money in your policy without you knowing it. And you can't assume that your policy is growing without us having a conversation. So we have to work together. There's some responsibility that I have, but there's some responsibility that you have in this process as well. So all in all, you might want to move me over to the bottom corner. All in all, where in this IBC structure, whether we're talking, again, infinite banking, if you're, again, depending on your goal, if you're using your policy for infinite banking or you're using your policy for supplemental income, doesn't matter. Where does this break down? Where do these issues occur? There are some things that you are responsible for. There are pieces of this puzzle that you need to be conscious of and aware of. And then there's some things that are outside of your control. What are you responsible for? Well, how you fund this policy matters. And specifically as it relates to Kyle's policy, I understand he wanted to do a 5-pay. Again, fund his policy with $1 million for 5 years. Hard stop. Well, if it was me involved, we can do a 5-pay, but there is some ongoing contribution you want to continue putting in your policy. Why? There are fees associated with this policy, and we want to make sure those fees are not causing your policy to poorly perform. So putting an ongoing contribution in, and it doesn't have to be $1 million, but putting an ongoing contribution in helps offset that fee structure, which allows your policy to continue to grow. Loan management errors, meaning if I'm using this policy for infinite banking, if I'm using this policy to borrow against and do some type of external investment, how much I am borrowing, when I borrow, and how I pay it back matters. Because if I expect to borrow from my policy and never put that dollar amount back in, it can cause a detrimental impact to your policy that you may not be able to come back from. I'm dealing with several clients right now who are transitioning from their whole life policy to a properly designed IUL. And the issue is a 1035 exchange can't happen because there's no cash value in their policy to take because of loan management errors. And then assumption problems. And I think this is a big one. And I think there's a lot of onus on assumption problems, but the biggest piece is the impact of monitoring the spread. When you're dealing with a policy that you're borrowing against, understanding what that loan rate is and how your policy is growing matters. I have a lot of clients with whole life policies where their loan rate is higher than the growth in the policy. Meaning the dividend growth might be 5%, but the cost to borrow their funds is 7%. That's a 2% difference, meaning when they borrow their money from the policy, it's costing them 2% inside the policy. If you don't pay attention to that loan management, it could cause the cash value to be eaten up by the cost of the loan. So you want to be very conscious of the impact of the money that you're borrowing. And then tax regulatory events, policy lapse, understanding what is the impacts to your policy, what caused it to lapse, how your policy is being funded. How close are you to MECing your policy? Some agents use MEC as a scare tactic. MEC is just saying, am I buying the least amount of life insurance, the amount that I'm contributing? Am I putting the maximum amount into my policy? You want a policy right up to the MEC limit. You MECing your policy, I, as the agent, would have to allow that to happen. That's not something that I would do. But understanding where that point would be and what those guardrails are is important. And then sustainability, suitability, misfit. Here's what's interesting about Kyle Busch's policy, and we haven't talked much about this, but if you're getting a life insurance-based policy and you have a career that life insurance companies view is a risk, maybe this strategy is not right for you. Maybe your health is a detriment to how this policy performs. So maybe, and again, just hypothetically, maybe it would have made more sense to put this policy on Kyle's wife, because Kyle, being a NASCAR race driver, his cost of insurance would be considerably higher. I don't know that it would be 12 times it was stated in some of that detail that we found, but his cost of insurance would be higher compared to his wife, who is not a NASCAR driver. So maybe it would make more sense, if the goal is income, to put the majority of this policy on his wife so that it's growing at its maximum amount. So suitability misfit is important, because maybe we need to identify a better strategy for you. These you control. But those that are out of your control, again, we've kind of walked through the policy design and carrier product risk. We want to make sure that we understand what questions to ask to be able to identify what those issues are. So out of that, what moral of the story here is, when you're looking at your policy or looking at potentially getting a policy, or you have a policy you want you better understand, my first question for you is, what's the purpose? Why did you get it? What's the goal of this policy? Because based off the goal, we want to make sure the structure of the policy fits and allows you to accomplish whatever that goal is. And for those of you who may have a policy and would like to understand whether or not your policy is structured effectively, the easiest thing you can do is jump on my calendar. I know I covered a lot here, and the best, well, the next slide actually has it, because I know it's kind of hard to read against the white. The best thing that you can do is share your policy with me. It will take me 30 seconds to understand whether or not your illustration is structured effectively or not. I do this often. Whether you get a policy with me or not does not even matter. Knowing whether or not your policy is structured correctly and functions correctly is really important. And you don't need me to do it. So if you want to know more, want to learn more, want to understand whether or not this policy is something that, the policy that you currently have is something that's structured correctly, head over to selfdirected.info/calendar, click on calendar and jump on my calendar. There's a lot of, well, I'm going to say there's a lot of space available, but it's actually filling up. Because we've been spending a lot of time talking about self-directed 401ks, this fourth quarter is really filled with making sure people, my self-employed individuals, are becoming properly structured. So be careful. If you don't find time, let me know. I may be able to squeeze you in on weekends as well. I do work weekends from time to time, but the bottom line is, jump on my calendar, or you can email me a copy of your policy, and I will be happy to review, take a look, and assess whether or not your policy is structured correctly for you. I think that's it, sweetheart.
Okay. Well, so far we don't have any questions, so that's good. We have I think there's a fire hose of information. Yeah. And unless you're really familiar with this case, then, but there was a question earlier though that I did want to bring up. When it was, why would somebody do a 1035 exchange? Like why would this even happen at all? Why would this be a consideration?
Quick example. Let's say you've got $100,000 of cash value sitting in an old, or whole life policy that you haven't really been monitoring, and after watching this, you realize, you know what? A leveraged IUL would work better for me based off my goals, but I got this old policy over here I don't really know what to do with. Well, if you wanted to move that $100,000 from that whole life policy into a new IUL, you want to be conscious of the impact. Like, does it create a taxable event? Like, what is the impact of doing so?
Right.
Well, just like you roll over an old employer's plan into a new retirement account, you can roll over an old cash value life insurance policy into another spot in the form of a 1035 exchange. And what ends up happening is we can move that 100,000 of cash value into the new policy, and it does not create a taxable event.
Okay. And speaking of taxable events, I think that that's another unfair piece of this is in all of the assessments that are being done, like retirement, classifying it and qualifying what was the intent of this policy as retirement income in order for it to qualify as retirement income by standards of a financial advisor, for instance, it would be considered a withdrawal. It would only be, the comparison would be considering a withdrawal. And so therefore it would become a taxable event, and therefore it changes the landscape entirely.
Right.
Again, with the unfair comparisons, not what you can do and how you can leverage this, how it could work for you. It's let me pull out anything that could benefit you here, only to compare something that is unfair. You wouldn't want to do it this way regardless, but I'm going to position it to you in this way because it benefits what I'm talking about. So it's while you're out there in these streets, folks, and you are Googling up this case, because you're gonna see it everywhere. There's people doing reels about this. It's blowing up. It's going viral right now. It's important for you to just go grab the information filed with the court. We put the QR code up. Go grab it so that you can have access to the information, and you're not getting it through somebody who is sliding it based off of what they want for shock value, citing it for benefit to whatever they do, so that you can feel educated about this. The other part is you'll learn a lot about people through something like this. When you start information that's going viral, and you start with all of the information that anybody would have access to, and then you see what people are leaving out, that's probably the most important part of all of this. Like, you learn a lot about people in this process. What I really do appreciate about this is that we have lost my train of thought. What I hope you take away from this process is that information is out there, and this particular thing is very possible, unfortunately, but it is just not an IUL versus whole life. It is not a product-based problem. It is an industry problem.
I think that's my biggest takeaway from everything that I've gathered thus far is it concerns me. We talk a lot about will it make the boat go faster, which implies there's a boat, which means we're all in it. And when we're talking about life insurance, there's not different life insurance boats. We as life insurance agents, we as a life insurance community are all in the same boat.
Right. Well,
so what this meaning
I'll let you cook
as an asset base is what I'm saying. And so my point is, this is an industry issue, and what I hope comes out of this is a better understanding of, you know what, if this is a vehicle that I'm going to jump in, I have to be better educated as a life insurance provider so that I'm doing right by my client. I have to fulfill that fiduciary standard that I took a test and said that I was going to do, which means I need to not look at this as a grifting opportunity, more of a how can I better support this client base to make sure that they are achieving their goals, which means I might have to get educated. I might have to learn a little bit more. I might have to spend a little bit more time over on Donnell and Angelique's channel to understand how these things work, because I know there are a lot of life insurance agents watching this. They spend a lot of time understanding or trying to understand what it is we talk about, because we are very open and honest about how these things are structured. And this is not something that is taught in a class. This is not something that most agencies even tell their agents about. Most people do not understand how to structure a policy. So the more you know, the better we can serve. And the better we all understand, the better this industry of life insurance will actually be. So what I'm hoping comes out of this is an improvement in the industry.
Yeah, no, I love that you have that amount of hope. I do not. No, I love that for us that you have that hope. My hope died when we got out there to try to educate real estate agents. That was I'm not gonna get into it all, okay? Because he knows I just get triggered when we talk about this. But this is another situation where people were not being educated on a particular product and what could benefit their clients. And so we said, hey, do you want us to come and educate you? And your clients made all of these materials to educate the client, the broker, the agent, whoever. And then the agent was like, oh, I don't want to learn anything. So I'm not going to tell anybody about it. You know what it was? It was the CARES Act and the new law that allowed people to borrow and dip into their retirement funds for particular purposes. One of those was buying a residence. You would think that real estate agents would have been all over this and they'd be the first people out the gate talking about it because it would have helped them get more clients, sell more houses, whatever. But they didn't want to learn about it. That's it. That's why their clients never learned about it, because they didn't want to learn about it and they didn't want to represent something they didn't feel super confident about and they didn't need it past a year, right?
And the best we can do is arm you with the information.
Yeah. Well, anyway,
Go ahead.
that's where life insurance agents are right now, because there's a lot of these like MLM style network marketing styled agencies and brokers out here, and they're not leading with look at the amount of people that we can help. They're leading with how much money you can make. And if you don't believe us, go watch the video that we made. This was like 2-3 years ago, and it's still happening. And then you go on TikTok, get your feet all seasoned up, and then all of a sudden you start seeing all these people only talking about the money that they're making, and it's crazy. So then you ask them like, okay, if you want to serve people, come over here where you have to have less commission, less fees. You get to help people though, right? No, why would I do that? Literally, why would I do that? Because it actually helps people. But that's a rant for another day, friends. And I will spare you all that. That is my biggest pet peeve. And I wish that things could change, but we see where the world is going. And so the best thing that we can do is arm, not just on the agent side, right? Arm people who are out there educating and leading in this space and help and making those decisions, pushing the button for the action to happen, but helping the other people on the other side of it be educated so that they're not in the hands to have to trust somebody who is just saying, trust me, it's all going to be good. Because the truth is, when they looked back at this policy, the insurance company, the agent, and if the client would have also checked in at year 1, checked in at year 2, checked in at year 3 to see, hey, how's this policy going? Is it on track for what you said it was going to? They would have seen that it wasn't in year 1. They would have seen that it was not at all in year 2 or year 3. It wasn't until year 6 when he got that
New premium payment
request that he went, hold on a second, something's not right. And I mean, he's busy. He's busy. So I understand that this, again, I'm not victim shaming here. That's not what I'm doing. The point, though, is that there were a lot of opportunities along the way, and they just were not, they weren't taken advantage of, unfortunately.
I think the moral of the story for me is strategies. Whether we're talking infinite banking concept, which is a strategy applied to a cash value life insurance policy, a leveraged IUL, which is a strategy applied to an IUL. These strategies have to be managed. These strategies have to involve not just you as the owner of the policy, but also the agent that created the strategy. And in order for this strategy to be properly executed, it takes all involved to actually play their roles.
Yeah, you're right. And we do need more people to stand up. So if you've been learning and you feel confident, and Jason here, How to Invest, is a perfect example of a person who first was just learning and now is each one teach one, right? And so jumping out there, if this is something that you're passionate about and you feel confident about and you feel like you want to be the change that you wish to see, do it. Literally do it. But we've seen this happen before too. We've seen people get sucked up in that other thing. I'm not going to talk about that. We're just going to move forward here into Gabo's comment, which is, so Jason, yes, get in here. Okay. Gabo says, can you put up the QR code again? I was just taking pictures of Donnell all that whole time instead. Yeah. Do you mind? We'll put that.
Give me just a minute.
There it is right there. Just for those who, that's what was filed with the court in North Carolina, I believe. I think so. Yes.
Yes, it is.
North Carolina. And so this is where you can get it. So now you have what everybody else has, truly, unless they have some sort of inside information. How would they have gotten it? Who knows? But what can be proven is right here. And why wouldn't it be in here? Why wouldn't it be in here? Obviously the illustration's not in here, those types of things. I'm sure some AZ, North Carolina, I'm sure attorneys everywhere are going to love this case and peeling back the layers and what is allowed to be presented or public. So, we're not going to miss out on the tea in terms of what this means legally. That could be very interesting, very fascinating. But just so that you're aware of what it is that people are talking about, what they're referencing, more importantly, though, what they're leaving out and what they're not talking about, and how they're representing this information or molding it, shaping it to some sort of narrative. That's probably the most dangerous and the most effective way to use this information, is just to arm yourself. No, that's not a thing. That's something that you are parroting. This is what you could say is what I mean. No, that wasn't in there. That's something you're parroting that you heard on another reel that somebody else parroted that they heard on another reel, and it actually isn't even a part of the case at all. And that's what we're seeing posted as articles as if it's legit. Which is it? It's got to be one number consistently across the board, and it's just not. So that just goes to show that a lot of people are just grabbing at this stuff, or they're relying on ChatGPT to do it, and they're not verifying or double checking. So this information's out here. If you're out there writing an article and you needed to find this information, there you go. But facts matter, right? Okay, so we so Donnell say cheese. He's gonna take another picture. Okay. All right. Well, I think that's probably good for us. I hope you got enough. You can scrub back if you didn't, to take a picture anyway of that. And if you are new, you can take a picture of the QR code and then hold down on it, and it should take you to the link the same way. Okay. So I think that's good. We don't need to hold anybody here any longer. Anything else you want to share?
No, I think today was, I'll call it lengthy, but the piece, if you left with nothing else, it would be understanding what questions to ask. And if you have a policy that you're unsure as to how it's structured, share it with me. It takes 30 seconds to be able to identify how your policies function. And this is not an IUL versus whole life discussion. This is a structure. This is a design discussion. This is it's really more about whether or not your policy is designed to do what whoever said it was supposed to do. And if not, how do you course correct as quickly as possible? So, yep, I'll leave it at that.
All right. Well, we always, as with anything, especially when it comes to life insurance policies or your wealth building journey, time is the most valuable asset that we have. And we are so grateful that you're spending your time here with us. We always like to end our streams with, if you didn't come from a wealthy family,
you can make sure a wealthy family comes from you.
So stay tuned.
Stay protected.
Stay focused.
Stay connected.
My name's Angelique.
And I'm Donnell.
And our goal is to help you
get self-directed.
And to do that, we have a ton of free resources. So don't sleep on those. We're here every Tuesday, 5:30 Pacific Standard Time, 8:30 Eastern Standard Time, and all the standard times in between. We really appreciate you guys tuning in. And thanks for everybody who jumped in the chat. We really can't thank you enough for the time that you have spent here with us and the time that you have shared our information out, or our lessons, our streams, our rants out with your community so that you can bring others into the conversation. So we really appreciate you all. That's it. That's a wrap, right?
That's it.
All right. Till next week, guys. Thanks so much.
Hey, before you go, we want to remind you that becoming fully self-directed means gaining complete control over your wealth, time, and freedom. It's not just an idea. It's a framework, a mindset, and the power to make informed decisions to secure your future. Being here means you're taking those steps, and we want to thank you for allowing us to guide you. We believe that we grow farther and faster when we grow together. So tune in next time and tell a friend to tell a friend. We've helped thousands of people just like you start their journey to financial freedom. And if they can do it, you can too. And if you're ready to learn more, we got you. Get a head start by grabbing these 2 free books. But how do they get them, Donnell?
Head over to my website where you'll have access to a few things. A ton of free resources, case studies, and over 100 5-star reviews from people just like you. And in 15 minutes, we can explore what's possible for you. So don't wait.
Invest in what you want, when you want.
But first, let us help you
Get self-directed.